Alright, hey everyone, Julian Marchese here. In this video, I'm going to give you guys an update on my positions and basically what I'm looking for the markets to do in the next week. If you've been following my Twitter or if you've seen my blog on Friday, you'll notice I updated you guys that I've basically switched from a bullish position in risk-on assets to a bearish position with the equity, I guess you could call meltdown we saw on Friday. And in this video, I guess I'm going to give you guys a verbal reason why I've done this if my previous points haven't made it obvious enough. But I'm going to also give you my expectations as to what I think we're going to see in the markets. So first of all, let me review again why I've switched from a bullish position to a bearish position. And I'll also give you a little time frame during the day of when I really switched over. I was actually slightly bullish around this time frame, which was Thursday. And after the unemployment report, I got slightly more bullish on the open, and basically at around 11 o'clock, once we started testing the 1370 area again in the S&P, I flipped my long positions to a short position in equity, and also so in the S&P 500 I also got short the NASDAQ around here, and I also got short copper basically on the breakdown, actually on a bit of a pullback right here, which is basically flat right now. I'm also looking to get into oil on a bounce, should we see a bounce towards the $100 level. But once again, let me explain to you guys why. And as I went into the unemployment report on Friday, I had a slight bullish tendency for risk-on markets to go up, especially the U.S. equity markets and commodity markets such as oil and copper. And the reason I had this view was that basically I felt that the U.S. equity market at this point in time would be the best place to put your money into versus any other equity market in the globe, for obvious reasons. Right now we have a low interest rate environment in which people are sort of forced to put their money into riskier assets as interest rates are so low right now in so many countries around the globe. So, you know, people are kind of forced to put their money into assets such as equity and commodities, global commodities such as copper. And that's basically what we've seen since the beginning of the year. If you take a look at any other equity market around the world, we could look at Germany. Germany has obviously came back, but is not too definitely hasn't recovered since last year's drop. And as we know, Germany is the powerhouse in Europe right now, and so we've been seeing more inflows into Europe. You can also take a look at the UK, and the UK really hasn't seen much of a rally this year. We're slightly up in the UK. And then when you look into any countries that have been obviously doing poorly, like Spain, Spain has obviously not been doing too well. China has not been doing too well. We haven't been seeing a lot of growth in China over the last few years. And then we can take a look at India as well. India has been falling off a cliff, basically. So we all did see kind of an inflow into global equities in the beginning of the year, but we're all starting to kind of tail off. See that in Italy as well. We did see some purchasing in the beginning of the year, but now people are starting to sell off. And obviously, it's completely normal for people to get out of the riskier countries first. And that's what we've been seeing. We've seen Spain show the greatest weakness first, then it kind of went into India. Then we saw it obviously fall out into Italy and Germany, which we saw the sell-off in April. Now, U.S. equity markets have held up during that entire time. This is the S&P 500. So basically, I was believing that we were going to see a move higher for the fact that the U.S. just looks like the best place to put money into equity-wise. So my belief was that as long as the U.S. economy sort of holds up, as long as it's not starting to um, go into a soft patch, and as long as Europe kind of stays under the radar for now, I felt that we would have seen another push up into highs in the S&P. However, my main idea was that we were going to see some sort of pullback in U.S. equity markets, and the better reward to risk trade was to short equities. Um, as we know, the S&P 500, well, the U.S. equity markets have been sort of held up by the promise of the Fed. A lot of confidence in the U.S. equity market has been because of the Federal Reserve and also for the reasons I've mentioned before in this video. But once again, what I do want to make clear is that at some point this market is going to have to come in just because of technically it's been overbought and the global worries don't just go away. For example, Europe's situation is very bleak right now, and it's not like the markets are just going to ignore that for now. At some point, these fears are going to come back into the market, and this can either be expressed through a sell-off because of U.S. Fears starting to creep in, or just Europe getting worse again, which is kind of what happened last year during August. We obviously saw U.S. fears creeping in because of the debt debacle, what happened with the debt limit, and then we saw European fears take over as we got closer and closer to the end of the year, until obviously we had in November the central banks around the world come together to inject liquidity into the markets, which has spurred a very nice rally. But now I believe that this creeping fear that the U.S. economy is starting to slightly slow down is coming into the equity markets, and we are starting to see the start of a correction in equities. And so now I'm just gonna basically give you guys a kind of my projections on where I think these markets are kind of headed over the next few weeks. Now, Friday was a kind of a pivotal day, I would call it. It was the biggest sell-off we've had this entire year, with the S&P futures market down basically about 24 points. And if we take a look at the volume on the SPY, it was sort of above average. Definitely not very above average. As you can see, this year has seen the lowest average volume since 2008, and there's many implications as to why we've seen that. But there is volume starting to come back onto the sell side. And as you can see, there's been some intermarket divergences. If you take a look at the Dow, we made a higher high 4 days ago. I believe it was on the ISM, which was Tuesday, yes. And then if you take a look at the S&P or the Nasdaq, we've made lower highs. Also, notice how the Nasdaq had the hardest fall. The Nasdaq is more of a riskier index, so it has technology is kind of considered more of a riskier place to put your money compared to what's in the Dow, for example. So the Nasdaq saw a harder sell-off as people are moving out of riskier assets. That's just another heads up. Oil was kind of the biggest heads up I could think of to get short, or to think that we are going to see a correction in the U.S. equity markets. Notice how oil just got destroyed over the last 2 days, and not really because of any news pertaining to the commodity itself, just because of basically some of the economic reports we've been getting out of the U.S. So, that kind of shows that the markets are pricing in kind of a slowdown, as commodities are obviously used when the economy is doing well, and not as much when the economy isn't doing as well. So we're starting to see oil really come down. We've dropped $8 in the last 3 days, and that's definitely a significant heads up to take a look into. And oil definitely looks technically broken. And from previous correlations, what we've seen in the oil to equity market is if oil's going down, usually the stock market's going down. So Now that we've seen a confirmed breakdown in oil, I would be expecting to see the equity markets follow suit. So back to the S&P 500, we are coming to an area of support in around the 1355 level, and you know we're coming into it with a strong bearish outlook. Very rarely do we see a powerful day like this in which it is immediately reversed, especially when we're actually near a support zone. Now, many people would look at this as, well, aren't support levels supposed to be held? Typically, wouldn't a clear support zone kind of give you the feeling that we should see a reversal more so than any random down day where and it's coming into no real support level? And the reason why I think there's more of a chance that we're going to go lower because of the support level is that the market just tends to trade towards extreme levels. And the 1350 level you can consider an extreme level, as we've only really been there 2 days over the last 2 months. So the market is going to want to test that level again to see if there's any prospecting buyers to take the market higher. If there's not as many buyers, and the reason why there shouldn't be as many buyers is, number one, poor, lackluster economic reports coming out of the U.S., European fears once again. That should drive the S&P 500 through the 1350 level, and then below there, we've really got the 1340 level, which was this pullback we've seen there. And that level could easily be broken, in which we could see the 1300 level. So a breakdown to the 1300 level, or a pullback to around there, would be kind of over exaggerated, but definitely a possibility. So that's basically what I'm expecting in the equity markets. I really think we're going to see now a breakdown. At first, I did believe we were going to see a rally to new highs before we saw a pullback, but it looks like this is not the case. And there is definitely some significant economic risks in the U.S. now that the job market appears to be slowing down. Obviously, this can change in the next couple of months, but until then, you sort of have to be bearish now that the market has basically told us that it's bearish, and I would expect a breakdown of the $1350 level in the S&P 500, in which we could see a sell-off even lower. So that's basically what my projections are for the coming week. Once again, I think we're going to see a continuation of the sell-off in riskier assets and a move into less risky assets such as treasuries. I think we're going to see another test of these highs in the 30-year bond market, which is around the 146.28, so 147 area level. All right, so just want to give you guys an update on what I expect for the coming weeks. Hope this helps.